what happens when a bank loan isn't the right option? And you're probably asking, well, why not just go to a bank? That's the first place that often comes to mind for businesses. And I guess there are a couple of things to think about if you haven't already. Most traditional banks have very stringent lending criteria. Small and mid-sized businesses can and often do fail to meet those lending standards, and that limits their access to capital. The time involved, a prolonged approval process, and you might not have, if you need a big infusion of cash, the luxury to wait for an extended period of time. Traditional bank loans can take weeks or longer to process, delaying critical funding when you really need it. Alternative financing solutions like unsecured working capital loans and lines of credit offer funding big chunks of cash in a short period of time when you need that for your business's continuity and growth. One of the options, the alternative financing options to help bridge a slow period or fuel growth when a bank loan is not an option, is an unsecured working capital loan from a private lender. The way it works is that once you're approved, you get a lump sum of cash, often just a couple of days from first applying. These loans are very flexible. They let you cover anything, really anything connected with the business: payroll, inventory, vendor payments, expansion. They don't require collateral, so your assets are safe and you keep full ownership of your business. So in terms of how you qualify for an unsecured working capital loan, private lenders focus on a few key things. Revenue is probably the major item. Revenue consistency. They're going to review 6 to 12 months of your bank statements, typically looking at that period or longer to assess your cash flow. And that's going to factor prominently into the formula of what they end up lending you. For example, if your business pulls in regularly $50,000 a month, you might qualify for $25,000 to $62,500, roughly 50% to 125% of your monthly revenue. They'll look at how long you've been in business. They really want you to have been up operating at least 6 months, more likely a year in some cases. That's just kind of gets you over. It's a good length of time. Credit score, again, the emphasis might be on revenue consistency, but credit does come into it. A score of 600 plus helps. 700 will get you better rates, but there are some that say, there's no floor to your FICO score. The debt to income ratio, lower debt relative to revenue, will increase your odds of getting funded and getting a larger amount. It should not be a shock to hear that these loans come with higher interest rates due to lender risk. The approval is based more on revenue via bank statements or tax returns than credit scores, and they don't require collateral. So the trade-off for the lender is absorbing a lot of risk. They're building in a higher rate on the loan to address that, and defaulting on your end can mean legal trouble or credit damage or both. So it's very important to weigh the risks and to understand that you have a path, you have a schedule to get these repaid and address that. That's built into your plan for whatever length loan is. I think the best way to approach these vehicles is eyes wide open. That's the first thing. And as a short-term, a temporary solution when a bank is not an option, versus a long-term operating strategy, which based on the rates, that's not likely to be sustainable or workable at all or to your advantage in the long term. The reality is if you have a lull or an unanticipated problem, you need a big infusion of cash quickly. This is an option, but just to make sure you have a clear path forward to repay and actually move on from it versus incorporating it into your business as a regular vehicle is really important. So a business line of credit from a private lender is structured differently from an unsecured working capital loan in that it's set up as a revolving line where you can withdraw funds as needed up to a set limit and pay interest only on that which you borrow. So there's definitely some variation within the private lending community and variation on the types of business lines of credit that are offered. And for instance, on the loan amounts, they can run anywhere from $1,000 up to $500,000 or greater. It really just depends on your financials and your whether or not there's collateral, a lot of other factors. In terms of funding speed, for private loans, you can get funds within 24 hours with some programs. Others may take 5 or 10 days. In terms of repayment terms, anywhere from 3 to 18 months. That's on the revenue-based lending platform, all the way up to 5 years for things that are more asset-based. So when it comes to interest rates for business lines of credit for private lenders, I don't necessarily think it's wise to try to ballpark them here, only because they can and do fluctuate for a number of reasons. But a safe place to start is knowing that the rates for private lenders are going to exceed those of traditional banks. The spread between a traditional bank's line and a private lender's line can be a few percentage points, or it can be significantly higher. So the advantage to working with a private lender business line of credit is you've got convenience and flexibility. You have funds immediately on hand when you need them on an ongoing basis versus in one short burst. And you can address gaps, slow periods, if you need to get a new system, if you need to switch things up, go for expansion opportunities. You have the funds available. And I've always thought, if you're in the middle of a business issue, which usually comes without any warning, you have to deal with that and give that your full attention. The last thing you want to do is have to be reactive and go out and seek funding on the spot. That's where that can affect a lot of things, including your decision making with the terms. So I think it's a great just to have this on hand to address things as they come up on a selective basis. The other thing is you're paying interest on only that which you borrow. So those are two great advantages. So as with any loan, a business line of credit is intended to make your life easier. It's intended to give you some breathing room to be able to address things calmly and methodically. And I think that a couple things is very important to review the terms prior to signing. Make sure to read all the clauses so that you avoid any penalties for late payments, or if there's a fee due here or there, make sure you're aware of that and build it into your operating budget. It's important to utilize the line carefully. Things come up. That's why you have it in place. But as much as possible to earmark it for very specific circumstances at specific times, that's going to be very helpful. And the repayments be factored into your operating budget. Again, if you use the line indiscriminately without any internal guardrails, that can be very damaging. And at the end of the day, it's accumulating debt, which has an impact on your cash flow and your credit. Guys, thanks very much for joining me today to take a look at alternative financing solutions for business owners. If you are a business owner and you're interested in funding, I've included links below in the comment section and description. Appreciate you checking them out if you do need some help. And thanks again for joining me.